And welcome to our webinar series, Ethical Decision Making for Investment Professionals. Special thanks to CFA Institute for their partnership in presenting today. And we want to welcome our fellow Southeastern region societies in attendance today, and also our friends out in LA, North Carolina, Minnesota, PA, and San Francisco. I want to mention a couple of upcoming Society of Atlanta events. We've got our 18th annual Southern Classic CFA Institute Research Challenge on Saturday, February 28th from 9 to 1. Our annual Women Networking and Finance Celebration on March 12th from 5:30 to 7:30. And a webinar series, Technology and AI Impacts on Investment Research and Compliance on March 18th from 12 to 1. Please check our website for these and other upcoming events and register now. We're thrilled to be joined today by John Stokes, Director of Ethics and Professional Standards at CFA Institute. His responsibilities include developing, maintaining, and providing interpretation on the organization's Code of Ethics and Standards of Professional Conduct, Asset Manager Code of Professional Conduct, and other ethics codes and standards. We're also joined today by Andrew Crane, Director of Ethics and Professional Standards at CFA Institute. Based in London, Andrew brings over 30 years of global experience across financial markets, compliance, and regulatory leadership. Before we get started, please feel free to use the chat feature within your Zoom controls to share questions or comments throughout the session. We want this to be interactive and valuable for you. And with that, I'll turn it over to John to begin.
Thanks, Kathy. I really appreciate it. Thank you all for joining us. Very happy and delighted to be, Andrew and I are both delighted to be here with you to speak on this important topic of ethics in the investment profession and building an ethical culture in firms. Andrew and I are part of the CFA Institute Research and Policy Center, and our goal is to be a positive influencing force in the global investment industry. The RIS works to transform research insights into actions that strengthen markets, advance ethics, and improve investor outcomes. So the RPC brings together CFA Institute expertise as well as diverse cross-disciplinary community of practitioners, subject matter experts to work collaboratively to address these complex problems. We're committed to delivering an independent perspective and actionable insight and anchored to the mission of CFA Institute that elevates the profession and the industry. And of course, an important part of the RPC is standards. So I'm going to briefly talk about what we're going to talk about today. We're going to touch on building an ethical culture for investment firms and encouraging ethical conduct. We're also going to be introducing you to our CFA Institute Ethical Decision-Making Framework. This is the primary way to do this, not only having a good code of ethics for building a culture of ethics, but is also to train employees and investment professionals on developing and implementing an ethical decision-making framework. And we're going to talk about what that looks like today. But finally, we're going to be talking and doing a lot, hopefully a majority of the time, talking about applying that framework to case studies. And these case studies are often built, many of them are built on real-world situations from either professional conduct, CFA professional conduct cases, or regulatory action. So we're going to be applying the ethical decision-making framework for that. And Kathy mentioned this being an interactive session. It's much, we're going to have, there's going to be a lot of opportunity for you to chime in with your comments and thoughts on chat. We're going to be asking questions about, what do you think is the issue? What do you think the issues are here? What's the right course of action? So we really encourage you to get the most out of this webinar to, contribute your thoughts and insights. So when we talk about ethics and culture and code and standards and the ethical decision-making model that we're going to talk about today, a lot of times we get, we make these presentations, we get kind of pushback. Culture is irrelevant. Clients just care about returns. You really can't teach ethics. You're either ethical or you're not. I'm an ethical person. I don't need training. And you may encounter some of the same skepticism, but hopefully after today, we'll give you new ammunition to counter these misconceptions. So let's start by talking about establishing an ethical culture at a firm. And I guess the first question I'm going to ask, and I again ask you all to chime in with your thoughts, is why, at the very basic question, why is it important to establish an ethical culture at an investment firm? I think some of us can think of some obvious answers, but let's hear from the audience. What do you guys think?
Yeah, either raise your hand or put something in the chat. We can pick it up either way.
Well, of course, ethics develops trust. So you want to have investment firms that manage other people's money, and often large sums. And so clients, whether they're individuals or institutions or governments, need to trust that the firm will act responsibly. And once trust is broken, either through fraud or insider trading or just general misconduct, it's very hard and very costly to repair. So an ethical culture, it certainly can help build trust.
John, we got a couple of responses in. I definitely like Luke Jacobs. It's always the right time to do what is right.
That's a great motto. Thanks, Luke.
But again, maintaining integrity of capital markets, client trust coming through,
Yep.
aligning interests.
All good reasons to establish an ethical culture at an investment firm. And again, we mentioned trust, we mentioned reputation of the firm, of course. Risk management. Unethical behavior can expose a firm to financial, legal, and operational risks. Loss of client assets, lawsuits, penalties, reduced investor confidence. An ethical culture helps identify and address small issues basically before they can grow into major problems. Obviously, an ethical culture encourages regulatory compliance, prevents violations of the law before they occur. You can reduce fines and sanctions and legal costs if you have a well regarded and implemented ethical culture. It encourages proactive risk management, as we mentioned. An ethical culture is often seen as an underpinning philosophy that supports the hard controls of the policies and procedures of compliance programs. So that's kind of, you have your policies and procedures, but if they have their foundation in ethics. An ethical culture can attract and retain top talent. Promotes accountability and integrity, encourages open communication, and reduces toxic behavior and internal conflict. And employees are more likely to make decisions aligned with the firm's values and less likely to engage in unethical conduct when firms respect and support their values and professionalism of the employees. And finally, long-term value creation. Firms that prioritize ethics tend to make more sustainable investment decisions, avoid short-termism and reckless risk-taking, and build more resilient business models. So this helps align firm performance with the interests of clients, shareholders, and society at large. So an ethical culture in sum is not just a nice to have thing. It's not just window dressing. It's a strategic asset. It protects the firm, supports compliance, builds trust, and enhances long-term profitability. I want to show a couple slides that kind of give some empirical support to these points. This is a slide from something called the Edelman Trust Barometer, which is an annual survey conducted by the Edelman firm that measures public trust in various institutions like businesses and government, media, and non-governmental organizations. And it uses a globally distributed online survey to gather data and analyze public attitudes towards these institutions. And this helping to understand how trust shapes societal forces and informs leadership and policy decisions. So this is a survey of 28 countries. There were 33,000 respondents. And this is a slide from the Edelman Trust Barometer of 2025. And the question asked here of the general population is, please indicate how much you trust businesses in each of these categories to do what is right. And these, this is the bars are the total amount of trust, and the circles are the kind of year-to-year changes at the bottom. So, you know, at first glance, this may seem positive. Financial services gets 64% of the trust of respondents to the survey. But I want to note two things. First is this is low compared to other industries like telecom and retail and entertainment and even airlines. So, you know, that's not a great endorsement that those somewhat questionable at times industrial sectors or sectors have more trust amongst the respondents than the financial services industry. And the second thing I want to note is, like, this says 64% of the industries of the 64% of the respondents trust this industry to do the right thing. Well, that means about a third of the respondents don't trust this of the financial services industry to do the right thing. So that's a little bit scary. And then over the years, CFA Institute partnered with Greenwich Associates to go a little deeper than the Edelman Trust Survey. And so in 2022, we published our fourth Investor Trust Survey that examines perceptions and expectations with respect to trust in the financial services industry. And we surveyed over 4,000 retail and institutional investors from a variety of countries that are significant to the investment industry. And one of the questions we asked investors was, what is the most important attribute when hiring a financial advisor or asset manager? And the two most important attributes, as you can see here, for the investors in hiring a manager are having a financial professional they can trust to act in their best interest, and having a financial professional that can generate high returns. But notice that just as important as high returns is having a strong commitment to ethical conduct. So other trust-related factors like an asset manager recommended by someone I trust, or having an advisor that is compliant with industry best practices, is more important or just as important as fee structures. So I think you can combine these 6 factors into 2 broad categories: trust factors and financial considerations. About 2/3 of the investors pick trust factors such as someone I can trust, commitment to ethical conduct, and compliance with best practice. 1/3 of the investors choose financial considerations like investment returns and fees as the most important hiring factors. So it seems clear that when investors are making a decision to hire a manager, they value demonstrated ethical behavior. Being able to trust a firm is just as, if not more important than the level of fees or performance. So investors want to be able to trust the people they hire to manage their money. They depend on investment professionals with their financial well-being, and they're seeking ethical behavior. But as significant minority, about 1/3, don't believe that their advisors are trusted to do the right thing, like always putting clients' interests first. But what do we know about this? Well, what we know that functioning, efficient capital markets depend on the trust of the participants in those markets. Trust can only be earned through ethical conduct on the part of market participants. So ethics then is crucial to market integrity. Now that we understand why an ethical culture for investment firms is critical, how do firms go about building it? So how do you think you build an ethical culture in an investment firm? Any thoughts on this? You want an ethical culture at a firm, where would you start? Well, I think the first place to start would be the leadership, the tone at the top, if you will. You lead by example. Senior leadership must consistently model ethical behavior in all decisions and interactions. There got to be clear values and visions. Define and communicate a mission and core values that prioritize integrity, fiduciary duty, transparency, all of the important ethical principles. And accountability. Hold all employees, including executives, accountable for unethical behavior. So starting at the top. So once you have a commitment by the leadership for an ethical culture, what sorts of things can be implemented to create the ethical culture?
And John, just as you were talking, we were also getting a couple of people coming through with tone at the top, leading by example. So focusing on that leadership
Number
of the
one,
firm.
that's a great, thank you for those responses. That's a great, obviously the most important, or at least a starting point for building ethical culture. Well, once the leadership is committed to an ethical culture, there can be a number of initiatives that can be implemented in order to create the ethical culture. You can start with incentives that are aligned with ethics, a balanced compensation, the bonuses and promotions not only tied to performance metrics, but also ethical behavior and client satisfaction. They can be tied to a long-term focus, avoid short-term incentives, that may encourage risky or deceptive practices. Along with the incentives, the hiring and promotion and compensation practices as well. Ethical screening, incorporate ethics-based questions and background checks into the recruitment process. Promote ethical leaders, reward individuals who demonstrate integrity and ethical decision-making, and not just those employees who are high performers. You have to have open communication and reporting channels. Safe reporting mechanisms, establishing anonymous whistleblower hotlines or to ensure non-retaliation policies as well. Encourage questions, create an environment where staff feel comfortable asking about ethical concerns without fears. A clear code of ethics and standards of professional conduct, and we're going to talk about that a little bit more later on. But this can include formal documentation of a detailed, accessible code of ethics and conduct that reflects regulatory obligations as well as internal standards. The focus should be on the client. Emphasize duties such as acting in the best interest of clients and avoiding conflicts of interest. A good code of ethics has real world relevance, and they can include case studies and scenarios specific to the investment decisions and client interactions of the firm. Once you have a code of ethics established, there's got to be education and training on that code. Encourage open discussion about ethical dilemmas and gray areas, possibly through workshops or roundtables or training. And the training needs to be, a regular, constant feature of the firm. Conduct frequent ethics and compliance training that are tailored to the roles of the investment professionals, not just general ethics training. Once you have established all of these things, the oversight and monitoring are important. For example, you could create an ethics committee from a cross-functional group of employees with different responsibilities to oversee culture, investigate concerns, review policies. That would also be a strong compliance function. You need to perform. You could, as a firm, perform regular internal and third-party audits to identify ethical risks and assess adherence to policies. And then once all of these are established, you have a good, strong code of ethics, a strong compliance function. You've undertaken ethics and education and training. Firms have to be responsive to misconduct that does arise, investigating issues promptly and applying fair, consistent consequences to those that are found to be violate the code of ethics or the policies and procedures of the firm. And again, transparent communication. When appropriate, share the lessons learned on a firm-wide basis to reinforce accountability. So I've highlighted 2 items on this list, the code of ethics and education and training. So let's talk a little bit more about that. Of course, all of you are familiar with the Code of Ethics and Standards of Professional Conduct, which you all have to, as CFA charter holders and members, have to abide by. I won't spend a lot of time on this necessarily, but I do want to highlight that the Code and Standards, for those of you who don't know, was updated in 2024 to reflect, and the major updates were adding a new standard and revising 2 of the standards that were in existence. So the new standard that was added had to do with a member's competence. Although the Code of Ethics mentions competence, there was no specific standard on competence. So there's a new standard that says that basically members must act with and maintain their competence. And the changes to the existing standards, one had to do with client communication. There was a section added to that requires members to not only disclose the parameters of the investment decision-making process, which has always been there, but there's an element to the investment decision-making process, the costs of the services, the nature of the services, and any fees that you charge for those services arguably are part of the investment decision-making process, but we made that explicit. So there's a new element of disclosure of fees, of services, and costs. And we also revised slightly the conflicts of interest standard, which related to this conflict of interest standard. Originally it was disclosing conflicts of interest, making sure you disclose conflicts of interest. The guidance to that standard has long said, it's best to avoid conflicts when it's reasonable to avoid conflicts. The board decided to raise that guidance into the language of the standard. So now the standard is to avoid or disclose conflicts of interest, with the emphasis on avoiding conflicts when you can. Along with the new standards, we have published a new Standards of Practice Handbook, which has been incorporated into the CFA program. And there was new guidance, new cases on a number of different standards that weren't addressed, that didn't change, but there was new guidance that was added to these standards, primarily around duty to employer. The professional conduct program gets a lot of cases relating to leaving the employer and what duties you have to your employer as you're transitioning to a new employment. So that was one of the big areas where we talked about. There's also a lot of confusion amongst members who are being investigated by the professional conduct program regarding what constitutes professional conduct. I mean, the Code of Ethics and Standards of Professional Conduct of CFA Institute applies to a member's professional conduct. Of course, we want people to act ethically in all aspects of their lives and responsibilities, but CFA Institute is primarily interested in or governs your professional conduct. So there's a definition of professional conduct that was included, and that was included as part of a glossary, which is new, a glossary of terms, important terms in the Code of Standards. So all of this guidance was included in the new handbook. So I just want to mention that in case you all were not aware of that. Along with the CFA Institute Code and Standards that are applied to members, we also, of course, have the Asset Manager Code of Conduct. And this, again, is a principle-based, investor-focused code of conduct that is applicable to global firms, regardless of region or regulatory scheme that they are subject to. That was developed by CFA charter holders, a volunteer group of CFA charter holders, and is based on the CFA Institute Code and Standards for individuals. Now, we were getting a lot of questions and a lot of queries about, how I'm as a CFA charter holder, I'm a member of CFA Institute, and I abide by the code and standards. I want my firm to adopt the code and standards for all of their employees. Well, the code and standards are really written for individuals, so we developed the asset manager code, which is written towards to firms, but again, is based on all of the ethical principles found in the code and standards. So the asset manager code, again, the idea is to enhance trust within the industry, and improve the client and stakeholder relationships of the firm. This is a voluntary code; it's not required. But it signals as a commitment to professional excellence and a culture of integrity for those who do adopt the code. It distinguishes them at firms, AMC compliant firms, as committed to the highest ethical standards. Adopting the code establishes sound governance and corporate responsibility to lead to better outcomes. Again, it can attract investment professionals, as we already talked about, as far as wanting to work with an organization that's committed to ethics, and has a number of other benefits that clients can see, potential employees can see, and regulators can see. Again, this is voluntary, but it's much like the GIPS standards, the Global Investment Performance Standards. Firms comply, notify CFA Institute of their compliance, and we publish the firms that do on our website. We publish the firms that do claim compliance with the AFC. Okay, so cover establishing the code of ethics for the firm, the importance of ethical culture. One way to do that is develop a code or comply with that codes that are out there. So how do you encourage ethical conduct? For the next few minutes, we're going to talk about how firms can educate and train employees on contributing to the ethical culture by engaging in ethical conduct. I think, everyone can recognize there's always going to be bad actors in any industry, but 99% of investment professionals, and certainly a much bigger portion of that, of our members, are committed to ethics. They're honest, they want to do the right thing. So let's examine how firms can encourage and engender ethical conduct through training. And effective training begins with examining what makes honest, ethical, well-meaning investment professionals engage in unethical conduct. One thing that can prevent us from considering ethical conduct is to justify to ourselves why the easiest or most self-serving course of conduct, but not necessarily the most ethical choice, is okay to make. We give in to temptation, and then we try to rationalize our behavior rather than thinking hard ahead of time about the ethical implications of what we're doing. And rationalization allows us to engage in unethical conduct without damaging our belief about ourselves that we are good, honest people. So we've listed some popular rationalizations that you may hear on this slide. The first strategy, rationalization, the strategy associated with denying responsibility. It's not my fault. My boss is telling me I have to do this. The next, rationalization is to deny injury. What I'm doing is not really hurting anyone in the long run. It could have been a lot worse, or I might be exaggerating a little bit, but investors are smart. They really won't be fooled. So there's not really any injury. Or denying that there's a victim. Everybody understands how the game's being played, or if investors are gullible enough to believe this stuff, they deserve to lose money. Social weighting, that's something you might be able to see. There's what I'm doing is nothing compared to how badly my competitors are acting. Others are much worse than me. So, and finally, the ledger is what I call the ledger. I can do this one little thing because of all the good things I do for my clients or my employer. So even if I'm taking advantage of investors now, they're still way ahead of the game by coming to me. So firms need to highlight to employees that, if they hear themselves making these rationalizations, alarm bells should be going off. They should be immediately realize it's time to think a decision. So along with rationalizations, there could be other reasons that investment professionals may engage in unethical behavior. I want to ask a question, kind of a poll question, so just chime in in the chat with what you think. But what do you think has more influence on whether a person will engage in unethical conduct? Is it their disposition? Is it their character? Or is it the situation that people find themselves in?
And for speed, people can just put a D or an S in the chat if they like.
It's always an interesting question. I'm basically an unethical person, so that's why I act unethically, or I'm an ethical person, but my situation is causing me to act unethically. What's more
John,
important?
I'm going to say it's about 60-40 in favor of situational influence at this stage.
Okay, good. Well, again, thanks for chiming in with your thoughts. And I think the 60 are on the right track, because there actually have been studies that show that a person's circumstances may have more to do with their behavior than their character. So under the right conditions, ethical individuals can be influenced to act in an unethical manner. And one of the most famous experiments around this was the study done called what they term now the Stanford Prison Experiment, which was conducted by Professor Philip Zimbardo at Stanford University, which took a group of college students and assigned them to be either prisoners or guards in a simulated jail for several days. And Zimbardo found that the group selected to be guards began to act aggressively, while the group selected to be prisoner, while first obedient, began to act out. So it was their circumstances that the students found themselves in that Zimbardo concluded, and not their inherent character traits or how they behaved inherently, that influenced their behavior. So situational influences can influence a person to engage in unethical behavior. Anyone can think of any situational influences that come to mind that might be circumstances causing unethical behavior? Again, chime in on the chat if you will. Any situational influences you've affected that may guide your conduct professionally in a
I'm getting
negative way?
pressure from your boss, or potentially losing your job.
Absolutely. Obedience to authority. Yeah, that's high up there. We're asked to do something we normally wouldn't do by someone in authority, either a supervisor or a director. We may be more likely to engage in that conduct, even if we don't think it's right. There's a natural tendency to want to please authority, especially in the workplace environment where doing so is a key to success. We simply carry out instructions without even reflecting whether it's the right thing to do. We rationalize behavior by saying, "Oh, I want to be a team player. I want to be loyal. I want to do what I'm told." Conformity with others. If others are doing something, we want to conform with the group. Everyone else is engaging in these actions. It must be all right. Following group decisions, group think versus independent thinking, and that's kind of related to conformity. The decisions that are made as part of a group reduces an individual's feeling of accountability and responsibility. So, I didn't make this choice. I was part of a group that decided, and we all can't be wrong. Incrementalism is another one. This is the proverbial slippery slope. Might start to cut corners and engage in small things that eventually lead to bigger problems. Overconfidence, and this is a big one. It's especially among, the kind of educated, talented, driven, and successful people like, that are in the financial services industry. We're so sure that we're smart enough not to put ourselves in a compromising position or to get into trouble. We don't even think about the ethical implications of what we're doing. So it's, the feelings of confidence and superiority lead us to make decisions, again, without important reflection. And again, responding to incentives or framing. We talked about incentives earlier. you're gonna do, if the incentive structure is often framed to meet certain objectives, like either achieving a high investment return or increasing investments under management, assets under management, without taking into consideration other important factors like developing trust among clients. So you can see there are a lot of not so obvious influences that may be at work to steer you off the ethical path, and we have to neutralize or eliminate these influences to keep them from directing our conduct towards an inappropriate action. We have to be willing to adjust our course of action to counteract the negative situational influences. And firms can encourage employees to do this by recognizing that ethical dilemmas are a normal and predictable part of the investment profession. It doesn't mean, if you find yourself in an ethical quandary, it doesn't mean you've done something wrong. But education and training to encourage employees to be more conscious about their thoughts and behaviors, and to reflect on what they're doing from an ethical standpoint will increase the likelihood that employees can notice these ethical problems and issues before they become destructive. And doing this involves following an ethical decision-making framework. And CFA Institute has developed a framework that we're going to talk about right now. This is the ethical decision-making framework. It's basically 4 parts. The first part is in the upper right-hand corner, is to identify. You want to identify the ethical principles involved in the situation you're in. What fundamental investment profession principles are at issue in a particular situation? What are your duties to others in this situation if you find yourself in a situation? What are the important facts? What facts or additional information do you need to make an informed decisions if you don't have those facts? And again, to identify, are there any conflicts of interest or incentives or relationships that are influencing your actions? So the first part of the ethical decision-making framework is to identify these important things: the principles, duties, facts, and conflicts. The next is to consider the situational influences. We just talked about situational influences. What are the outside pressures or internal biases that might be affecting your decision? Consider alternative actions. Are you just pointed towards your initial reaction and how to be and what conduct to engage in, or are there other potential actions? Consider additional guidance. Have you sought the objective assessment of other parties to gain additional perspective? Sometimes, there may not be time to do that, but if you do have time, you should seek out additional guidance, whether it's from a supervisor or a colleague or compliance or a number of different sources to get an additional perspective. So once you've identified and considered the different action, identified the important facts, the important issues, and considered alternative actions, you need to act. And again, the specific action will depend on the situation. Some decisions may not require any actions or multiple actions, or maybe acting it means elevating the issue to a higher authority. That might be, elevating your concerns to the more appropriate party, whether it's a supervisor or the firm leadership or compliance. And then once you act, the final step is to reflect on what you did, what you learned about what happened, the consequences, once you've taken the action, take time to review the path and what was the results of that decision. And this is going to make, as you implement this framework in making your profession and conducting your professional responsibilities, it will come more naturally. So again, this is kind of a summary: identify, consider, act, and reflect. And so now we're going to talk about some actual case facts and allow you the opportunity to implement the ethical decision-making framework in these cases. One of the things you have to identify, of course, as part of the first step, is to identify the fundamental ethical principles involved in each in each scenario. I'm not going to spend a lot of time on these. They're all incorporated in the code and standards, and you'll recognize a lot of them. Of course, clients' interests come first. Conflicts of interest we talked about. Transparency is a huge ethical principle, so you want full and fair disclosure. And again, all of these are found in the code and standards. So think about these in the first step of applying the ethical decision-making framework. When you see the facts and you consider the facts, identify what are the ethical principles involved, who do you owe a duty to, what do you have all the information you need, and are there any conflicts? All right, so let's take the first case. And again, hopefully this is interactive. So as you read the case and apply the ethical decision-making framework, just pop in your thoughts into the chat.
Whilst we're waiting, John, I'll just remind you we've got 20 minutes left.
Got it. Thanks, Andrew. Appreciate that. We'll get through as many of these as we can. Give everyone a few moments to just read the case, read those facts. What do you think the course of action? What do you think about Sneed's course of action in this case and applying the ethical decision-making framework? Would you recommend that he have acted any differently? Thoughts on what the ethical principles are here, or the duties?
I've got Mark. Just you can't see the slide, but there's no multiple choice. This is just outlining the case and looking for judgment. Okay, Peter, referencing need to make sure the policies would be good for the fund's members. Diane coming in, pension fund investments may be confidential, do not share them. The investment strategy may also not be appropriate as between the two funds. Mark,
I think those are really good points. I mean, one of the things you have to do is identify the ethical principle, and one of the ethical principle here, I think, has been pointed out, is the confidentiality of information. What is Sneed has a duty to keep the employer information confidential. So that's a good point. That's
confidentiality and the potentially differing objectives as between the church or the endowment and the pension fund.
Absolutely. Suitability of these investments. Are these investments going to be suitable? Are pension investments going to be suitable for the endowment? So you get, those are the ethical principles involved. Are there seem to be multiple duties involved, because he's got obviously a duty to his employer, duty to the pension fund, but he's also serving an outside entity, and they've chosen him presumably because he's got expertise and his background, his professional background. So has some duty to the outside entity, the endowment that he's sitting on. So this is, these are two conflicting duties, and you have to address that conflict. I think one of the things you have to identify too is important facts. What's the type of information being given here? Is it public? Is this information available to the public, or is he sharing private information? Of course, we've already mentioned confidentiality. If the private information is confidential, that's going to be an issue. Is there any? I mean, he's not sharing it with a competitor of the pension fund or a comparable entity. Acting for a charity, does that make a difference? What if he got permission from the fund? Does that make a difference as well? Again, the type of information that's being shared, is it general information, or is it, the general research maybe, is that okay to share or it's just not the listed investments? All of these things again, raise the issue that but by applying the ethical decision-making framework, can help you and would have helped Snead in this instance think about what some of these consequences. I mean, he may be thinking, well, it's a big company. They're not going to mind if I share for a charity. He's not trying to harm anybody. He's trying to help. He's trying to be a helpful investment professional. But by doing so without important reflection or applying an ethical framework, an ethical lens to the conduct, he may be getting himself into some problematic behavior. All right, let's talk about another case.
Just while people are reading that one, Mark, your earlier, can you see the slide now? Okay.
All right, what do we think about Jenks's conduct in this case? What did he act properly? He's certainly trying to protect client interests. We know that's a big ethical principle. What are some other ethical principles that might be going on here?
Okay, so we got material non-public information.
Excellent, material non-public information. So Jenks is at a presentation at the headquarters of this company. We don't know. I mean, one of the things you have to identify is the important facts. Is he the only person? Is he a group of several people? Is this presentation being broadcast over the web to everybody? We don't know so that's something you got to find out. That's something you would need to know. If not, if it's a selectively disclosed important facts about the company, that could be considered material non-public information, of course. So, material means it's going to affect the stock price. Non-public includes selective disclosure, not just disclosure to one person. So again, that's the ethical principle involved. We have the facts that we need to know. Well, what's the context of this presentation? Who's being given to? It's pretty clear that the information is material non-public information, but and Jenks has a duty to his clients to protect his clients. So he's found out about this information that's going to harm his clients, and he wants to address that for his clients. Is there anything wrong with that? Is there anything that trumps his duty to his clients in this case? Well, you always have to balance your conflicting duties. The duties of to your clients are paramount, of course, but there's also duties to the capital markets and to maintain the integrity of capital markets, and trading on material non-public information is really harmful to the capital markets in the sense that it makes, if that was allowed or is considered to be widespread, people are not going to, if the game's rigged, people are not going to participate in capital markets. So that leads to inefficient capital resource distribution and all sorts of negative implications by using material non-public information. And that's why in many countries it's prohibited. So again, if he
John, I
considered
think
this,
phase two,
Go
as
ahead.
well of the framework, talks about what are the alternative actions, right? So I think Jenks could also have raised with the company, is this material non-public information, and should they be making a disclosure?
Right. I mean, he could encourage the company to disclose this information. Yep, exactly. Certainly his own trading in the company is problematic because he's not protecting any interest there. He's protecting his own interests. But still, I think in this case, you can see that while protecting clients' interests is always a great fallback position, it's not going to be appropriate in this case. All right, let's go on to the next case. So here's a situation that someone is trying to basically protect client interests again, because he understands that the conduct of the firm is improper and wants to do something about it. What are the ethical ramifications of his actions here? Of course, he has a duty to clients. Who else may he have a duty to in this case? And what's
Duty
going
to
on as far as?
employer.
Go
He
ahead.
hasn't left the firm yet.
Hasn't left the firm yet. That was a big thing that we talked about as far as the update to the standards. What does it mean when you leave your firm? You have a duty to, the code and standards talk about a duty to employer while you're employed. And what do we mean by leaving your employer? Well, leaving your employer is not just, giving him notice that you're resigning. Generally, what the new guidance indicates that it means either you're no longer being compensated, or you no longer have responsibilities at your employer. So in this case, he has legitimate concerns about the conduct of his employer. He brings the attention to his manager, to the compliance officer, to the senior managers of the firm. So he doesn't want to participate in the misconduct. So he's trying to change the misconduct. But if you can't do that, ultimately, as a charter holder, you cannot be asked, you cannot participate in unethical conduct.
And Peter coming up with an interesting perspective, John, that the duty to client should trump the duty to your employer.
And I agree with that. I agree with that in this case, but there's a way to handle that. And the professional conduct program gets a lot of these cases. And what often members who are being accused by their quote unquote former employer of violating their duty to their employer interests is that, their response is, well, look, I have a duty to my client. I have a duty to the clients to tell them that they're being mistreated. And that is true, but you also, and if you strongly believe that, then you leave the firm. That's what you do. You leave the firm and let people know. But what you can't do is, have your cake and eat it too, by staying at the firm, by, promoting your new employer if you're going to a new employer, or your new business, and while being engaged while still being employed by your firm. So yes, you need to protect clients' interests, but there's ways to do it in a way that doesn't seem self-serving. Oftentimes these people will use, investment professionals who are accused of this will use the opportunity to promote their new firm, and that's just not that's going beyond protecting client interests by promoting your personal interests. All right, anything else on this, Andrew?
No, I think we're good to move on.
Okay. Have time for one more case, I think, before we wrap up. Seems to be another case where the employee is at odds with the employer. And again, it goes back to someone saying, look, I know I have a duty to my employer, but I also have a duty to my clients. I think these investments are appropriate. Is this any different than the last case?
A slightly longer read, so waiting for some comments to come through.
So in this case, the employers made a decision that, look, we're not going to sell these types of investments. We don't believe in, as an employee, as an employer, a firm decision. Our policies and procedures are we're not going to provide our clients with this type of investment. Salazar believes that that's wrong, that her clients could benefit from these investments, and basically says, I'm being restricted from this, and you are preventing me from following my duties to my clients by having an independent thought, independent objectivity, my diligence. I've believed that all of these my requirements under the code and standards are being violated. But in this case, this is all out this is not misconduct on the part of the firm. It's again, we'd have to know the important facts. Has this all been disclosed to clients? But if they say, look, we're going to manage your money, but we're not going to put you in these kind of investments that we think are risky or problematic in some way, and everyone knows that, and there's been communication with the client, again, with the new standard that says, you got to describe to clients what services you're going to provide and what services you're not going to be providing. So the fact that Salazar now disagrees with that is kind of impinging and not wanting to follow firm directive is problematic in this case.
Yeah, a number of responses now through, John. Basically, lobby internally with the firm, and if you can't get the firm on side, then you need to look for a new employer. Is the thrust?
I think that's right. Or, acquiesce to the firm's policies and procedures and say, look, I personally think these Bitcoin ETFs are fine. I think people could benefit from them, but as a firm decision, my firm wants to stay out of this realm. They've let their employees, let their clients know if the clients want these types of assets, they can go somewhere else. It's not a violation, or it's not a misconduct on the part of the firm that Salazar can now, override, if you will. All right.
Just with 1 minute, there's another perspective in from Diane, asking the question, what if she were to disclose the conflict, i.e. her perception of the investment opportunity versus the firm, disclose that to clients, but states that the firm policy does not allow her to purchase?
Well, I think that goes to basically undermining the firm by saying, look, the firm is saying I can't do this. I really think I should be able to do this, but since they're saying I can't, you're harmed. You're going to be harmed in some way. You're not going to be you're not going to be benefiting from my expertise as much as you could because of the actions of my employer. And I think that's just, again, that's going to go back to the duty of the employer. You as an employee are being compensated by this firm. You can't be engage in any conduct that undermines your employer. All right, I think it's all the time we have for today for these cases. There's other resources on the CFA Institute website if you're interested in looking at more of these cases. We have the Ethics Learning Lab that kind of walks through these a little more. There's an ethics casebook of about 200 cases like these that talk about the different ethical issues and ask you to again implement and use the ethical decision-making framework to guide your decision making with an ethical lens and ethical reflection, and that's important for developing not only your own ethical compass but the compass of a firm. So yeah, thank you all for attending. There's other resources on the website, and Kathy, I'll turn it back over to you.
Gentlemen, thank you so much for your insightful and thought-provoking perspectives today. And a big thank you to everyone who joined us. We truly appreciate your time and engagement. Be on the lookout for a follow-up email with a replay link, the presentation deck, and a brief survey. Your feedback helps us continue to deliver meaningful experiences and content. Thanks, gentlemen. Have a great afternoon, everyone.
Thank you.
Thank you. Bye bye.
Bye-bye.